Welcome back to the Deep Dive. Today, we are undertaking a pretty critical mission. We've got this, well, monumental stack of complex financial resources in front of us. It's really an entire framework designed for mastery, and our job today is to distill it all down into a structural blueprint.
That's right.
This deep dive is specifically, custom tailored for you, the diligent student. We're aiming not just to help you pass, but to really dominate that high-stakes financial management examination.
Absolutely the goal. We want to provide a comprehensive, clear roadmap. We're navigating the entire complexity of the syllabus here.
The whole thing.
Everything from the foundational objectives of the financial manager, the necessary modern tech skills you need, right through to advanced models like CAPM and, cutting-edge risk hedging techniques.
It's not just a summary then.
No, definitely not. This is about making sure you understand the application, the why behind every single formula you encounter.
Exactly. And this is about efficiency, isn't it? We're providing you with the high-impact knowledge you need for this kind of high-stakes learning. If you're serious about success, this structured approach, we think, is indispensable. We're turning theory into tangible exam strategy.
Let's do it.
And we are starting immediately with the battlefield logistics, if you will. Okay, so let's unpack this strategic approach. Starting with the immediate value for you listening.
Right.
How do you turn these initial study notes into, well, guaranteed high marks?
Okay.
The compiled notes are the foundation, definitely, but they are only step one.
That's such a crucial point. It's a hurdle many learners, frankly, fail to clear. You have this foundational knowledge, but it must be expanded.
How so?
Well, the full benefit really comes from engaging with supplementary video content, lectures, things that elaborate on the more complex topics. But the single, absolutely non-negotiable element for success, it's question practice. You absolutely must use a current edition of a revision or exam kit. You need those exam standard questions and, crucially, the full detailed answers.
Right, because without that rigor.
Exactly. Without applying the concepts under the exact time and pressure conditions of the exam, the theory just stays theoretical. It's fragile.
And this syllabus, it's so dense. Efficiency in revision has to be key. We need integrated tools, surely.
We do. Think about digital flashcards. They're highly effective for rapid recall of key terms, key concepts, like the definition of systematic risk or remembering the Fisher formula quickly. And furthermore, strategically placing online multiple choice tests, say, immediately after finishing a chapter. That's essential.
Why immediate?
It confirms retention before you move on. It's a mechanism for active recall, not just passive reading. Locks it in.
Makes sense. Active recall.
It's all about iterative mastery, building it layer by layer. You should also actively seek out revision lectures, and not just ones that review content. Ones that actively work through past exam questions. Watching an expert synthesize, say, a 20-mark answer, structuring the calculations, writing the discussion points, that is perhaps the most valuable learning you can do.
Seeing it done properly.
Precisely. And then, before exam day, the final crucial step, attempting a full, interactive, computer-based revision mock exam.
The full simulation.
Yes, it simulates the environment, builds crucial confidence, and maybe most importantly, reveals where your timing weaknesses lie. You find out where you're losing minutes.
Okay, let's pivot then to the logistics of the modern computer-based exam, CBE. Chapter 26 in the material covers this. This requires specific professional and technology skills that, frankly, directly impact your score.
Oh, absolutely.
You need proficiency with the software itself, not just the finance concepts.
Couldn't agree more. The CBE environment itself is a skill set. It must be practiced. You need to look at the navigation, the tools available right there on the exam screen.
Like what?
Okay, the top bar, that's where your power tools are. You've got the online calculator, and you absolutely must know how to toggle between basic and scientific modes, especially for things like IRR or, beta calculations.
Right.
Then there's the scratch pad. Now, this is a crucial mental safety net. It's for your rough workings. It will not be marked.
Good to know. Not marked.
But it helps you organize those messy calculations before you structure them properly in the spreadsheet.
And time management during the actual exam is so critical.
Yeah.
I guess you need to learn to use that flag for review option efficiently.
Yes. Use it to mark questions you initially skip, or maybe ones you want to revisit later for a final check. Don't waste precious minutes bogged down on one complex Section A question when you could be scoring easier marks elsewhere. Come back to it.
Sensible strategy.
And navigation should become instinctive. While the bottom bar lets you move sequentially, question by question.
There's a better way.
The Navigator option, it's your shortcut. It gives you direct access to any question instantly, saves critical minutes, especially under pressure.
Okay.
And never ever forget, you have direct access to the online formula sheet provided right there in the exam environment.
Ah, the formula sheet, lifesaver.
It can be. Knowing precisely where those complex formulas are, like Miller-Orr
Yeah.
or the ungearing formula, it saves you that cognitive load of having to recall them perfectly under stress. Just know where to find it.
Good tip. Okay, let's break down the 3 sections of the exam. The required technique differs for each, doesn't it?
Vastly different. Section A comprises 15 objective test questions, or OTQs. They're worth 2 marks each.
What do they test?
Mostly core knowledge, definitions, short, sharp calculations. They come in various formats: simple multiple choice, numerical entry, sometimes drag and drop lists. Quick hits.
Okay, Section A done. Then
We move to Section B. This has 3 objective test case questions. Each case gives you a scenario, a short story almost, followed by 5 questions.
5 questions per case.
Yes, 5 questions, 2 marks each, so that's 10 marks per case scenario. And the critical structural point here,
Yes.
these 5 questions are independent of each other.
That's important.
Very important. If you happen to misread the scenario slightly for question 1, it shouldn't automatically cascade and dune questions 2 through 5. It's compartmentalized. That's a crucial design feature you can use to maximize your marks.
Good. And finally, the big one, Section C.
The ultimate challenge, yes. Section C is the constructed response questions, or CRQs. You'll face 2 full 20-mark questions.
20 marks each.
Yes. Testing the deepest application and analysis. And this is where your CBE technology skills really, truly matter. You're required to use the provided spreadsheet environment for all the calculations.
All calculations in the spreadsheet?
All of them. You must practice using its built-in functions to maximize efficiency, especially the dedicated NBV and IRR functions.
Just don't do it manually.
Please don't rely on manual calculations or, heaven forbid, manual interpolation for IRR if the software provides the tool. It's slower and riskier.
Okay. And the written parts. Discussion points, analysis, recommendations, those must be written out using the word processor provided. The marker sees your logic, your formulas in the spreadsheet, and your written argument in the word processor.
So mastering Section C means mastering both tools.
Simultaneously. Spreadsheet and word processor working together. Okay, let's transition now. Let's talk about the core purpose. Defining the financial manager's role, the FM, and the vast environment they operate in.
Right, Chapter 1 stuff.
Exactly. The FM's primary singular objective is making the right decisions to achieve the company objectives. Fundamentally, for a profit-making entity, that means maximizing shareholder wealth.
And for nonprofits.
The mission still applies, they just adapt their objectives accordingly. Maybe maximizing service delivery within budget constraints, for example, but the decision-making framework is similar.
The source material we looked at identifies 4 key pillars of responsibility. These define the whole scope of financial management, don't they? And they seem to be continuous trade-offs, not just isolated decisions.
That's a perfect way to put it. Continuous trade-offs. Firstly, there's the raising of long-term finance.
Equity or debt?
Precisely. The decision of capital structure. Shareholders' equity or debt from lenders. The FM has to determine the optimal mix, the gearing level for investment and expansion, constantly weighing the cost and the risk of each source.
Okay, pillar 1. What's second?
Second is the investment decision. Where does the capital actually go? Evaluating things like factory expansions, launching new products, major acquisitions. This requires establishing really stringent criteria for accepting projects, which of course we'll cover in detail later under investment appraisal.
Got it. Investment decision. Pillar 3. This one seems crucial for day-to-day survival.
It absolutely is. The management of working capital, WCM. This is that constant balancing act between liquidity, having enough cash to operate, and profitability, not tying up too much capital unnecessarily.
Because WCM requires financing, but doesn't directly earn profit.
Exactly. That's the paradox. The FM needs sufficient cash, enough inventory, quick collection of receivables for efficient operations, but not so much that excess capital is just sitting there idle, not earning a return. It's a tough balance.
And the final pillar.
And finally, pillar 4 is the management of risk. In today's global, interconnected world, financial volatility is, well, it's a constant.
True.
This pillar covers handling risks that arise from fluctuating exchange rates, absolutely critical if you trade internationally, and also the volatility associated with changing interest rates, which affects borrowing and depositing funds.
And failure to manage these.
It can wipe out a profitable operation almost overnight. Seriously.
Wow. Okay, so moving outwards from the FM's direct roles, Chapter 2 frames the financial context. It starts with financial intermediation. What's that exactly?
Think of it as the vital mechanism, the bridge. Institutions like banks, pension funds, investment trusts, they bridge the gap between those seeking finance companies and individuals who want to invest or save their money.
So they match buyers and sellers of funds.
They do, but they provide crucial services that individuals just couldn't replicate easily on their own. Firstly, aggregation. They collect many small deposits and bundle them into the large lendable sums that companies actually need.
Makes sense. Little bits into big piles.
Secondly, maturity transformation. This is clever. An individual might deposit money for, say, 6 months, but a company might need a loan for 10 years. The intermediary takes these short-term deposits and transforms them into long-term loans.
How do they manage that risk?
They're essentially betting on the predictable flow of deposits and withdrawals over time. It works because not everyone withdraws at once.
Right. And the third service?
Diversification of risk. If you as an investor lent all your capital to just one company and they failed,
You lose everything.
100% loss risk. But an intermediary lends to hundreds, maybe thousands of different companies. This significantly diversifies and reduces the specific risk faced by any individual depositor. That stability is why they are so essential.
Okay. Intermediation clear. Finance is ultimately exchanged in financial markets, though.
Correct. And we need to distinguish the types of activity within these markets. You have the primary market.
That's for new shares or bonds.
Exactly. Where new securities are issued to raise fresh capital. This is fundamentally how companies grow by accessing new funds.
And the other type?
That's the secondary market. This is where existing instruments, shares, and bonds already issued are traded between investors. This doesn't raise new money for the company itself, but it's crucial because it provides liquidity and the valuation mechanism. It tells you what things are worth.
Got it. And these markets are segmented by time horizon, too, aren't they?
They are. Capital markets are for long-term finance. Think over 5 years, typically. This includes the official list for the big established firms, the alternative investment market, AAM, in the UK, for smaller, often fast-growing companies that need less stringent regulation.
Easier access to capital for them.
In theory, yes. And then you have the huge international Eurobond market. That deals in bonds issued in a currency other than the issuer's own national currency. So a U.S. company issuing bonds in euros, for example.
Okay, that's long-term. What about short-term?
Then you have the money markets. These are characterized by short-term lending and borrowing, usually under 1 year. This is mainly trading between financial institutions themselves.
Like what sort of trading?
Things like the discount market for commercial bills of exchange, the interbank market for very short-term funds, often overnight, and the euro currency market dealing in currencies held outside their home country.
And what about the middle ground? Say 1 to 5 years?
Yes. Medium-term finance. That typically comes directly from banks. It often falls sort of between the formal structures of the money and capital markets. A standard bank loan, basically.
Okay. Now, the stock exchange itself plays a big role here. What are its functions?
Its main job is to provide the governance structure. It aims to ensure a fair, orderly, and efficient market for the transfer of existing securities, and importantly, for raising new capital through primary issues.
How does it ensure fairness and order?
Through constant regulation. Strict rules about which companies are suitable for listing, enforcing public disclosure of all material information, good or bad, and trying to guarantee that all investors transact on equal terms. No hidden advantages.
And how are prices actually set on the exchange?
Pure market forces, really. It's the interplay of supply and demand. We often talk about bulls.
They think prices will rise.
Correct. They believe prices will rise, so they buy. And then you have the bears.
They expect to fall.
They anticipate a fall, so they sell, perhaps even sell short. What's fascinating, though, is that these speculative dealings, people betting on price movements far from being destabilizing, are actually crucial for market health.
How so? That seems counterintuitive.
They actually reduce market fluctuations. Think about it. If a stock price falls too low, maybe lower than its fundamentals suggest.
The bulls step in.
Exactly. The risk-taking bulls see an opportunity, believe it's undervalued, and start buying. Their demand helps arrest the decline.
And the reverse.
Conversely, if a price spikes perhaps too high too quickly, the bears might start selling short, increasing the supply of shares available, which tends to cap the price rise.
So this activity provides liquidity.
Absolutely. It ensures there's almost always a counterparty available, someone willing to buy when you want to sell or sell when you want to buy, and usually at a price that reflects the current consensus. It keeps the market moving.
Okay, that makes sense. And this leads us nicely into a really key theoretical concept, the efficient market hypothesis, EMH.
Ah, yes, EMH, a cornerstone. The definition itself is simple enough: a market where the security price instantly and fully reflects all available information.
Simple definition, but the depth comes from the different levels of efficiency, right?
Exactly. There are 3 levels. Level 1 is weak form efficiency.
What does that mean?
It means prices only reflect past prices. All historical price data is already baked into the current price. This underpins the random walk theory,
Which says
you cannot forecast future prices using past trends or patterns, technical analysis, chart patterns, things like that, because all that historical data is already incorporated. It implies technical analysis alone can't generate superior returns consistently.
okay, weak form, level 2.
Level 2 is semi-strong form efficiency. Now, prices reflect all currently public information.
So news, accounts, announcements.
Everything public: financial statements, news releases, economic forecasts, director dealings, disclosures. It's all in the price instantly. If a market is semi-strong efficient, you cannot generate abnormal returns by just analyzing public information better or faster than others.
So how can you win in a semi-strong market?
Price movements only happen when new, previously unknown public information is released. The only way to consistently beat a semi-strong market is by trading on unpublished, private information, insider information.
Which brings us to level 3.
Strong form efficiency. This is the ultimate level. Prices reflect all information published and unpublished.
Unpublished too, like secret R&D results.
Exactly. Secret R&D breakthroughs, internal management discussions about a takeover bid, anything material, even if it's known only to a handful of insiders. In a truly strong form efficient market, insider dealing gains would be mathematically impossible.
Why?
Because the price would already reflect that secret information somehow. The market, in theory, knows the secret even before it's public.
But is that realistic? Is the market really strong form efficient?
Well, the critical takeaway, certainly for your exam, and based on the evidence, is that because insider dealing is still strictly policed and people are successfully prosecuted for it.
Meaning gains are possible from inside info.
Exactly. It means the stock market is, at best, only semi-strong form efficient. It reflects everything public very quickly, but it doesn't reflect everything secret.
Okay, so semi-strong is the likely reality. What are the implications of that for the financial manager?
They're profound, really. If the market isn't fully efficient, isn't strong form, then the timing of corporate events matters hugely.
Like issuing new shares.
Precisely. Deciding when to release a new share issue becomes a high-stakes decision. If you release it just before some really positive public news is due, that could be highly advantageous compared to issuing it afterwards when the price has already jumped.
I see. What else?
It significantly complicates project evaluation, too. Remember, we need a discount rate, often derived from the cost of equity, which itself comes from the market price.
Right.
But if the market price isn't truly fair because the market isn't perfectly efficient, then the title derived from that price might not accurately reflect the true required return for the company's risk level. This makes setting the right discount rate for new projects much harder.
Tricky. Any other implications?
Yes, in the world of mergers and takeovers. If the target firm's share price is fair, as it generally would be in a semi-strong market reflecting all public info, then the buying company cannot expect to gain just by buying undervalued assets.
So the only way to win in M&A is
Through genuine synergy, achieving real economies of scale or operational rationalization benefits after the merger. You can't simply profit from spotting a mispriced target if the market is semi-strong efficient.
Okay, we've navigated the strategic landscape, the market environment. Now let's pivot to the daily survival game, working capital management, that essential balancing act between profitability and liquidity.
Absolutely. WCM, defined simply as net current assets. Inventory plus receivables plus cash minus payables. And you have to internalize that fundamental paradox we mentioned earlier.
Which is?
WCM requires financing, it ties up funds, but it does not directly earn a profit, unlike, say, a machine or a factory.
So the FM is always walking a tightrope.
Constantly, finding the optimal point. You need high enough WCM for smooth operations, no stockouts, ability to pay bills quickly, but low enough to avoid tying up capital unnecessarily. Reducing WCM can boost profitability, less financing costs, but cut too deep and you risk grinding the business to a halt. Liquidity dries up.
And this WCM investment, it's categorized for financing, isn't it?
Yes, typically into two types. Permanent WCM, that's the fixed baseline level of current assets needed year-round just to keep the doors open. That base level should really be funded by stable long-term sources like equity or long-term debt.
And the other type.
Temporary WCM. This refers to the fluctuations above that baseline, maybe due to seasonality or a large one-off order. These temporary bulges are usually financed by flexible, short-term sources like bank overdrafts. More risky, but flexible.
How do we assess WCM health? Ratios, I presume.
Ratios are the first port of call, liquidity ratios primarily. They confirm the firm's ability to meet its short-term liabilities as they fall due.
The current ratio.
The current ratio, current assets, current liabilities, is the main one. Ideally, you want it above 1, showing you have more current assets than liabilities. And then the quick ratio, or acid test.
That excludes inventory.
Yes, it excludes inventory, recognizing that inventory is often the slowest current asset to turn into cash. It gives a more stringent test of immediate liquidity. What the right level is depends heavily on the industry, though.
Okay, liquidity. What about speed?
Then we have efficiency ratios. These focus on how quickly things are moving through the system. Turnover rates, or days for inventory, receivables, and payables. They tell us how long cash is tied up in inventory, how quickly customers are paying us, and how long we're taking to pay our suppliers.
But ratios have limits, right?
Big limits. You must remember they are just a historical snapshot at one point in time. They can be skewed by seasonal factors or even deliberately manipulated through window dressing just before the year end.
And they're useless in isolation.
Pretty much. They only gain meaning when compared to industry averages, to key competitors, or to the company's own performance in prior years. Context is everything.
There's a more holistic measure, though, the operating cycle.
Yes, the operating cycle, or cash conversion cycle. This quantifies the total length of time from paying for raw materials to eventually receiving the cash from the sale of the finished goods.
How do you calculate that, typically?
A detailed calculation requires summing up the average days inventory is held. You might need to break this down into raw materials days, work in progress days, and finished goods days. Then you add the receivables collection period in days, and finally, you subtract the payables payment period in days.
Why subtract payables?
Because that period represents free finance provided by your suppliers. They are funding part of your cycle. The final net figure shows how long your capital is locked up.
And a lengthening cycle is bad news.
Generally, yes. It indicates a rising investment in WCM and signals a potential drain on liquidity. You need to investigate why.
We should also quickly touch on the dangers of mismanagement here. You can have too much WCM.
Which is overcapitalization. It's wasteful. Too much cash sitting idle, too much slow-moving inventory. It hurts profitability because that capital could be invested elsewhere, earning a return.
But the bigger danger is often too little WCM.
That's overtrading, sometimes called undercapitalization. This is a really dangerous situation. It happens when a company expands its sales revenue too quickly without securing enough long-term finance to support that growth.
So the business might look profitable on paper.
It might even be very profitable, but it suffers severe liquidity crises. Cash inflow just cannot keep pace with the outflow needed to fund the rapid sales growth. More inventory needed, more receivables created. It runs out of cash despite making profits.
What's the solution to overtrading? Cut costs.
Not necessarily. The fundamental solution isn't usually about cutting costs. It's about fixing the capital structure. It needs an injection of adequate long-term capital equity or long-term debt to support the higher level of activity.
Right. Okay, let's dive deeper into the components. Inventory management, Chapter 4. This is where the EOQ model comes in.
Yes, the economic order quantity model. The goal is quite simple conceptually. Find the fixed order quantity for inventory that minimizes the total annual inventory costs.
And those costs are?
It's a trade-off between two main costs. The cost of placing orders, reorder cost, $2 things like admin, delivery charges, and the cost of holding inventory. Inventory holding costs, sewage strata, warehouse costs, insurance, obsolescence, cost of capital tied up. Purchase cost of the items themselves is usually irrelevant for the basic EOQ calculation, unless...
It's their discounts.
Exactly, unless quantity discounts apply. The basic EOQ formula, which you should know, is text EOQ, where D is the annual demand.
That formula saves time, but the complexity often comes with those quantity discounts, right? That seems like a classic exam trap.
It is a common calculation area, yes. The supplier tries to tempt you, or maybe force you, to order a larger non-optimal quantity by offering a lower unit price.
So how should you evaluate these discounts systematically, say in Section B or C?
You need a clear step-by-step approach. Step 1. Calculate the basic EOQ ignoring any discounts. Then calculate the total annual cost at that EOQ level. That cost includes the total ordering cost for the year, the total holding cost for the year, and the total purchase cost for the year.
Okay, baseline cost calculated. Step 2.
Step 2. Calculate the total annual cost again, but this time using the minimum order quantity required to get the first discount level. You have to recalculate the annual ordering cost, fewer orders now, the annual holding cost, higher average inventory, and use the discounted purchase price for the annual purchase cost.
And then you compare.
You compare the total cost at the discount quantity with the total cost at the original EOQ quantity. You're looking at the saving from the lower purchase price versus the likely increase in the combined ordering and holding costs because you're deliberately moving away from the optimal order size.
And repeat for all discount levels.
Yes. Repeat this calculation for each discount threshold quantity offered. Finally, choose the order quantity, whether it's the original EOQ or one of the discount quantities that results in the absolute minimum total annual cost overall. The arithmetic can be fiddly, but the logic is pure optimization.
Is there an alternative philosophy to EOQ?
There is. The main one is just-in-time, JIT, inventory management. This isn't just a technique. It's more a philosophy seeking minimum inventories across the board, finished goods, work in progress, raw materials. Ideally, zero inventory.
Sounds great in theory. No holding costs.
Eliminates holding costs, yes. But the conditions required for JIT to actually succeed are incredibly rigorous, often impossible for smaller firms or firms without huge bargaining power over suppliers.
What kind of conditions?
You need a very short, very flexible production period. You need almost perfect demand forecasting. You need a highly flexible and multi-skilled workforce. You need exceptionally reliable suppliers who can deliver exactly on time, every time.
Quality has to be perfect too.
Guaranteed quality has to be built into the system from suppliers and internally. If one supplier fails to deliver, or if a single defective component arrives, the entire production line can grind to a halt because there are no buffer stocks.
So it relies on tight contracts.
Very tight penalty contracts with suppliers for reliability and quality are usually essential for JIT to function. High risk, high reward if you can make it work.
Okay, inventory covered. Let's move to receivables and payables management, Chapter 5. Selling on credit seems like a necessary evil.
It often is. It's expensive. Think interest cost on the funds tied up, admin costs, and the ever-present risk of bad debts. Yet in most industries, offering credit is necessary simply to remain competitive. Everyone else does it.
So the goal is to keep the level as low as possible.
As low as realistically possible, yes. Efficient management involves several things. Firstly, robust credit checks before granting credit, using credit rating agencies, taking up trade references, maybe reviewing recent financial statements.
And setting limits.
Yes, setting clear credit limits for each customer. Then, defining clear credit terms, maybe offering settlement discounts for early payment, but we need to quantify the cost of those discounts. And finally, having robust, systematic collection procedures for overdue debts.
Can companies outsource this headache?
They can, through factoring. You essentially pay a third party, a factor, to administer your sales ledger for you. They chase the debts.
Is that all they do?
That's the basic service. But they often offer more. They might advance you cash against the value of the invoices, say 80% immediately. That provides finance.
And they can take the risk too.
Yes, if it's non-recourse factoring. In that case, the factor also takes on the risk of the bad debt. If the customer doesn't pay, the factor bears the loss, not you. That's effectively a form of insurance, but it costs more, naturally.
Now, let's talk about the crucial examination arithmetic around the cost of credit. Offering a settlement discount. It can be surprisingly expensive, can't it?
Shockingly expensive when you annualize it. Let's take an example. Say you offer a customer a 4% discount if they pay you in 1 month instead of the usual 3 months. They pay 2 months earlier.
Okay, 4% for 2 months earlier payment.
That 4% saving over just 2 months translates into an effective annual percentage cost to your company of around 27.75%. It's incredibly high.
Wow. So how do you decide if it's worth offering?
You must compare that effective annualized percentage cost, the 27.75%, directly against your company's bank overdraft interest rate. If the annualized cost of offering the discount is lower than the cost of your overdraft, then yes, offering the discount makes financial sense. It's cheaper than funding those receivables via overdraft for those 2 months.
That's a critical comparison.
Absolutely vital for exam questions on policy changes. You need to calculate the net cost or benefit, comparing interest savings from reduced receivables days against the actual cost of the discount given, all benchmarked against the overdraft rate.
And the logic reverses for payables, doesn't it? Payables are a source of finance.
Yes, they're effectively free, short-term finance provided by your suppliers. Delaying payment as long as possible is generally good cash management practice. But there are risks.
Losing supplier goodwill.
That's one risk. Damaging relationships, maybe losing future credit status. But the immediate financial risk is losing valuable settlement discounts offered by your suppliers.
Ah, the other side of the discount coin.
Exactly. And the cost of refusing a supplier's discount can be even more eye-watering. Let's say a supplier offers you a tiny 1.5% discount if you pay them in 10 days instead of the usual 35 days. So paying 25 days earlier saves you 1.5%.
Seems small. Maybe just take the extra 25 days credit.
That's the trap. Refusing that 1.5% discount just to get an extra 25 days of credit translates into an effective annualized financing cost of nearly 25%.
25%, just for refusing a 1.5% discount.
Yes, because you're paying 1.5% for just 25 days of extra credit. When you annualize that, it's huge. The key insight, and a very common exam point, is that refusing a settlement discount is almost always far more expensive than using a bank overdraft to pay early and take the discount. Even if your overdraft rate is, say, 13%, paying 25% is much worse.
So always compare the annualized cost of refusing the discount to your overdraft rate.
Always. If the cost of refusing the discount is higher than your overdraft rate, you should pay the supplier early, using the overdraft if necessary, to secure that discount. It requires detailed calculation practice, getting those annualization formulas right.
Definitely need to practice that. Okay, finally, in WCM Cash Management, Chapter 6, why do companies hold cash anyway? Seems inefficient.
Well, there are 3 classic motives. The transaction motive, needing cash for day-to-day predictable payments like wages, suppliers. The precautionary motive, holding a buffer for unexpected needs or opportunities. And the speculative motive, holding cash to take advantage of unforeseen bargains or investment opportunities.
And in practice, the main tool is the cash budget.
By far the most important practical tool. The cash budget or cash flow forecast predicts surpluses or deficits month by month, sometimes week by week in advance. Its power lies in focusing on the precise timing of cash receipts and cash payments, not on accounting profit.
So it gives early warning.
Exactly. Identifying a potential cash deficit 3 months down the line gives the FM time to take corrective action in a controlled way.
Like
Reducing inventory levels, maybe deferring non-essential capital expenditure, delaying dividend payments, chasing receivables more aggressively, arranging or increasing an overdraft facility in advance, which is cheaper than a panic request, potentially selling surplus assets or considering a sale and leaseback arrangement. Or, on the flip side, planning how to invest a predicted surplus.
Are there more formulaic approaches to cash levels?
There are, though perhaps less used in daily practice than the cash budget. We have theoretical models. The Baumol model is a direct adaptation of the inventory EOQ model we discussed earlier.
How does that work for cash?
It calculates the optimal amount of cash to transfer from short-term investments, which earn interest, into the current account, which doesn't, each time cash runs low. It balances the fixed transaction cost of selling those investments against the opportunity cost of lost interest income by holding too much cash in the current account.
Okay, and the other model?
The Miller-Orr model. This one is designed specifically for businesses where cash flows are unpredictable, fluctuating randomly day to day.
How does Miller-Orr work?
It involves setting an upper cash limit and a lower cash limit. These limits are calculated based on the transaction cost of buying, selling investments and the statistical variance, a measure of risk or volatility, of the daily cash flows.
So you keep the cash balance between these limits?
Yes. The cash balance wanders randomly between the lower and upper limits. If it hits the upper limit, the model tells you to buy a specific amount of investments to bring the balance back down to a calculated return point, somewhere between the limits. If it hits the lower limit, you sell investments to bring the balance back up to that same return point.
Complex calculations.
The formulas themselves are usually provided, but you have to be very careful with the input, especially ensuring the interest rate and variance are expressed in the correct time units, often daily, which might require conversion from annual figures. All right, let's pivot now. We're moving away from the short-term survival metrics of WCM and into the realm of long-term growth and major decisions. Investment appraisal. Evaluating large capital expenditure projects.
Okay. Where do we start?
We start with the theoretically superior methods, the ones favored in finance theory. Discounted cash flow, DCF techniques.
Why are they superior?
Because they correctly account for two crucial things. Firstly, they focus on actual cash flows, not accounting profits. And secondly, they explicitly incorporate the time value of money, the principle that cash received today is worth more than cash received in the future.
And the primary DCF method is?
Net present value,
Yeah.
NPV. This is the gold standard. We forecast all the expected future cash inflows and outflows from the project year by year. Then we discount each of those future cash flows back to its present value using the company's required rate of return, its cost of capital.
And sum them up.
Yes, we sum up all the present values, including the initial investment, which is usually an outflow at time zero, already a present value. The result is the net present value, the net expected cash surplus or deficit from the project expressed in today's money.
What's the decision rule?
It's absolute and simple. If the NPV is positive, accept the project. If it's negative, reject it. A positive NPV represents the theoretical increase in shareholder wealth expected from undertaking the project.
Okay, NPV is key. What other DCF method is important?
Complementing NPV is the internal rate of return, IRR. The IRR is defined as the discount rate at which the project's NPV equals exactly zero.
So it's like a break-even rate.
Exactly. It's the effective percentage return the project is expected to generate on the capital invested. Managers often like IRR because sometimes the true cost of capital is uncertain or might change. Knowing the project's IRR gives them a sense of the margin of safety.
For example?
If the IRR is calculated to be, say, 20%, and the company's cost of capital is currently estimated at 15%, the manager knows there's a 5% buffer before the project becomes uneconomic.
How do we calculate IRR? Is there a formula?
There's no simple direct formula, unfortunately. We have to estimate it using a process called interpolation. This requires calculating the project's NPV at two different discount rates, ideally. One rate that gives a positive NPV and another rate that gives a negative NPV. Then you use a linear interpolation formula to estimate the rate that would give an NPV of 0.
So 2 NPV calculations needed for 1 IRR.
Typically, yes. Although the exam spreadsheet software might have a direct IRR function, you still need to understand the interpolation principle behind it.
Are there any shortcuts for discounting cash flows, especially if they're repetitive?
Yes, thankfully. Recognizing patterns saves a lot of time in calculations. If you have a stream of equal cash flows occurring over a fixed period, that's an annuity. Instead of discounting each year individually, you can use the annuity discount factor formula or tables to find the present value in one step.
And if the equal flow goes on forever?
If the equal cash flow is expected to continue indefinitely, that's a perpetuity. The discounting formula simplifies dramatically. The present value is just the annual cash flow divided by the discount rate, or using the perpetuity discount factor of Portugal. Spotting annuities and perpetuities is essential for calculation efficiency in the exam.
Okay, DCF methods are theoretically best, but the source material mentions other simpler methods are still used in practice.
They are indeed. Despite theoretical weaknesses, they persist. One is the accounting rate of return, ARR.
How did that work?
It's based on accounting profits, not cash flows. It typically compares the average annual profit expected from the project to the average book value of the investment over its life.
What are its weaknesses?
Its main weaknesses are that it uses profit instead of cash flow, and it completely ignores the time value of money. Two projects could have the same ARR but vastly different cash flow timings and NPVs, so it's theoretically quite weak.
And the other popular simple method?
The payback period. This is often very popular with managers, especially in highly uncertain or rapidly changing industries.
What does it measure?
Simply the time it takes for the project's cumulative cash inflows to recoup the initial investment outlay. How quickly do we get our money back?
Why is it popular if it ignores time value and later cash flows?
Because in a world of high uncertainty or fast-moving technology, a manager might understandably prioritize getting the initial investment back quickly. A guaranteed cash return in, say, 3 years might be preferred over a project with a potentially higher NPV, but where the big returns don't arrive until year 10, by which time the world might have changed. It's a measure of risk in a way.
Can you combine payback with DCF?
You can. You can calculate the discounted payback period, which uses the present values of the cash flows to see how long it takes to recoup the initial investment in today's money. It's a slightly better measure as it incorporates time value, but still ignores cash flows after the payback point.
Okay, we have the methods. But you said earlier the biggest challenge in IA isn't the formula, it's figuring out the relevant cash flows. Chapter 8.
Absolutely. This is where most marks are won or lost in Section C investment appraisal questions. Getting the cash flows right is paramount.
What's the overriding rule then?
The rule is not negotiable and has three parts. A cash flow is only relevant to the investment decision if it is. Future, incremental, meaning extra, caused by the decision, and actual cash.
Future incremental cash.
Yeah.
If it fails any one test.
It must be ignored, completely disregarded in your NPV calculation.
So let's be ruthless. What specific things must we ignore based on this rule?
Okay. First, sunk costs. Any money already spent or irrevocably committed before the decision is made is historic, not future, and therefore irrelevant. Ignore it.
Like market research already paid for.
Exactly. Second, non-cash flows. The most common example is depreciation. Depreciation is an accounting entry to spread cost. It's not an actual cash outflow, so ignore depreciation itself in your DCF calculation. Tax effects relating to capital allowances are different. They are cash flows.
Okay, no sunk costs, no depreciation, what else?
Book values of assets are irrelevant. Decisions should be based on future cash flows, not historical accounting values. Also, and this is critical, interest costs must be ignored.
Why ignore interest? Isn't that a cash outflow?
It is a cash outflow for the company, yes, but the cost of financing the project, whether through debt or equity, is already accounted for within the discount rate, the WACC, or cost of equity, that we apply to the project's operating cash flows. Including interest payments and discounting at the cost of capital would be double counting the financing costs.
Got it. So focus on operating cash flows, discount appropriately. Now, what about things we do need to include, beyond the obvious revenues and costs?
A key one is opportunity costs. These are subtle but important. An opportunity cost represents the value of the benefit foregone from the next best alternative because you chose to undertake this project.
Can you give an example?
Sure. Suppose the project requires using a warehouse that the company already owns. If that warehouse could otherwise have been rented out to a third party for £20,000 per year, then that lost rental income is an opportunity cost of using the warehouse for the project. It's a relevant cash outflow for the project appraisal.
So it's a real sacrifice, even if no cash directly leaves the company for it.
Precisely. It's an incremental consequence of the decision. Another one is the impact on sales of other products. If launching this new product is expected to cannibalize sales of an existing product, the lost contribution from those existing sales is a relevant cost for the new project.
Okay, opportunity costs. What about working capital? How is that treated in EA? This seems to trip people up.
It does. The treatment is specific and critical for Section C accuracy. Working capital, inventory, receivables minus payables, needed to support the project is typically treated as an initial cash outflow at time zero. It's an investment required to get the project running.
So outflow at the start, then what?
That amount of working capital is assumed to be tied up or held throughout the project's life. Then, crucially, at the very end of the project, that initial investment in working capital is assumed to be released or recovered. So it appears as a cash inflow in the final year of the appraisal.
Always recovered at the end.
Almost always. The main exception, and watch out for this wording in exams, is if the question explicitly states that the machine or factory being appraised will be immediately replaced at the end of its life with a similar one. In that specific scenario, the working capital investment is assumed to be rolled over into the replacement project, and therefore it is not recovered as a cash inflow at the end of the current project's life.
That's key nuance. Okay, working capital handled. What about taxation?
Taxation adds another layer of complexity, and it's very commonly tested. It usually introduces two distinct cash flow effects that you need to model year by year, often with a time lag.
First effect.
First, there's the extra corporation tax payable on the extra taxable profits generated by the project. This is calculated based on the project's revenues, less its tax-deductible costs, which include operating costs but exclude depreciation, and also less any capital allowances. This tax payment is usually assumed to occur with a delay, often 1 year in arrears, making it a cash outflow in the year after the profit is earned.
Okay, tax on profits. Second effect.
The second effect relates to those capital allowances, sometimes called tax depreciation. These are allowances the tax authorities permit companies to deduct from profits before calculating tax based on their capital investments. They effectively reduce the tax bill. So the tax saving resulting from these capital allowances represents a cash inflow or reduced outflow for the company.
And calculating these allowances can be complex.
Yes, the rules vary. It might be a straight line percentage each year, or, more commonly, a reducing balance percentage applied to the asset's tax written down value. You need to create a schedule showing the allowance claimed each year and the resulting tax saving, again, often assuming the tax effect occurs 1 year in arrears.
This whole detailed schedule, revenues, costs, working capital changes, capital allowances, tax calculations, all year by year with timings, sounds tailor-made for a big Section C question.
Absolutely. It's a classic 20-mark CRQ structure. You absolutely must practice setting these out clearly using the exam spreadsheet software. Getting the layout, the timings, and the signs, plus correct, is vital.
One last layer of complexity, inflation treatment.
Right. Inflation erodes the purchasing power of money over time. For consistency in your DCF analysis, you must always ensure your cash flows and your discount rate are speaking the same language, either both nominal or both real.
What's the usual approach?
The most robust and generally recommended approach, especially if different cash flows inflate at different rates, is to use nominal cash flows discounted at the nominal cost of capital.
What does nominal mean here?
Nominal cash flows are the actual inflated amounts you expect to receive or pay in the future, including the effect of forecast inflation. So you'd inflate your year one sales revenue at the expected sales price inflation rate, your year one labor costs at the wage inflation rate, and so on. The nominal cost of capital is the market rate of return, which also includes an element reflecting expected inflation.
So inflate everything, then discount at the market rate. Seems logical.
It is. It correctly accounts for potentially different inflation rates affecting different cash flow streams.
Is there a shortcut? You mentioned real terms.
There is a shortcut, but it comes with a big condition. If and only if you can reasonably assume that all the project's cash flows will inflate at the same general rate of inflation, then you can use the real approach.
How does that work?
First, you estimate all the project's cash flows at current prices, today's prices, ignoring future inflation. These are called real cash flows. Then you need to calculate the real discount rate. You do this using the Fisher formula. $1 plus I equals 1 plus R, 1 plus H, where $1 is the nominal discount rate and dollars is the general inflation rate. Rearranging gives you $3.
So calculate the real rate, then discount the current price real cash flows using that real rate.
Exactly. Discount real flows at the real rate. The beauty is, if the assumption of a single inflation rate holds, this real approach should give you exactly the same NPV and therefore the same accept-reject decision as the nominal approach. It can sometimes be quicker if calculating all the individual inflated flows is tedious, but be warned, if different flows inflate at different rates, you must use the nominal approach.
All right, we've appraised the investments. Now let's dive into how companies actually fund these long-term projects and, critically, how they determine the required rate of return for them, the cost of capital. Chapter 17 kicks off with evaluation of equity and calculating the cost of equity.
Right. CHEEC represents the return that the company's shareholders currently demand or expect on their investment, given its risk. We usually calculate this by effectively reversing the dividend valuation model. We know the current market price, we estimate future dividends, and we solve for the implied return.
How does the model vary?
Well, if we assume dividends will remain constant forever, which is rare for equity, the formula is simple. TOKI is T P-DOL 82. But for most growing companies, we rely on Gordon's growth model, which assumes dividends grow at a constant rate indefinitely.
That's the more common one.
Yes, the formula is TNE201 plus G P0 plus GL. Here, $D is the last dividend paid, $2 is the current ex-dividend market price, and $T is that expected constant future growth rate in dividends.
Okay, but estimating that growth rate,
Yeah.
That seems subjective. How do we do that? Is it testable?
Oh, it's definitely a testable skill. There are two main ways. Firstly, you could look at the historical pattern of dividend growth over the past few years and extrapolate that trend, assuming it will continue.
Using an average past growth rate.
Yes, often using a geometric average for better accuracy. But the second, more theoretically robust method is the Doolall-Dollar-BB-Baugh model, also known as Gordon's growth approximation.
$20. What do they stand for?
Doolall dollars R times BB. Here, B dollars is the proportion of earnings that the company retains and reinvests back into the business, the retention rate, which is 1 minus the dividend payout ratio, and $3 is the rate of return the company expects to earn on those reinvested funds.
Ah, so it links growth directly to reinvestment and profitability.
Exactly. It assumes growth comes from successfully reinvesting retained earnings. It's a powerful way to estimate D dollars because it connects the company's internal investment strategy and profitability directly to the market's expectation of future dividend growth.
Makes sense. Okay, that's cost of equity. What about the cost of debt?
Debt is generally cheaper than equity, primarily because interest payments are tax deductible for the company, creating a tax shield.
How do we calculate its cost? Does it depend on whether it's redeemable?
Yes, it does. For irredeemable debt that's never repaid, only interest is paid forever, like some perpetual bonds, the calculation is straightforward. The before-tax cost, $7 is simply the annual interest payment divided by the current market price. The crucial after-tax cost, which we use in WACC, is then ATD, where TALS is corporation tax rate.
Simple enough, but most debt is redeemable, isn't it?
Most corporate debt is redeemable, yes. And calculating its cost is more complex. There is no simple formula like for irredeemable debt. The before-tax cost of redeemable debt is effectively the internal rate of return, IRR, of the cash flows associated with the debt.
Which cash flows?
The relevant cash flows are the current market price, the initial inflow to the investor, or outflow if calculating from the company's view relative to market price, the series of future annual interest payments, and the final redemption value, usually par value, paid back at maturity. You calculate the IRR that makes the present value of the future outflows equal to the current market price.
So another IRR calculation.
Yes. And crucially, when you need the after-tax cost of redeemable debt for use in the WACC calculation, you must perform the IRR calculation using the after-tax interest payments in your cash flow schedule. That is, use 1/T each year, not the gross interest dollars. The redemption value at the end is not tax adjusted. Setting up this specific cash flow schedule correctly for the after-tax IRR is vital for Section C marks.
Got it. After-tax interest in the IRR calc. Okay, so once we have the individual costs, after-tax cost of debt, cost of equity, and maybe cost of preference shares if they exist, how do we combine them?
We combine them using the weighted average cost of capital, or WACC. As the name suggests, it's a weighted average of the after-tax costs of the different sources of finance the company uses.
And the weights are based on?
Critically, the weights must be based on the market values of the different sources of finance. Market value of equity, market value of debt, not their book values from the balance sheet. Market values reflect the current investor perceptions and costs.
So WACC represents the company's current overall blended cost of financing.
Exactly. It's the average return the company must earn on its existing assets to satisfy all its providers of capital.
Now here's the killer question, linking back to investment appraisal. When can we actually use this calculated WACC as the discount rate for a new project?
Yes. The single most critical question connecting these topics, WACC reflects the company's current overall risk profile and financing mix. Therefore, it is only suitable as a discount rate for a new project if and only if two strict non-negotiable conditions are met.
Condition 1.
Condition 1. The financing of the new project does not change the company's overall level of financial gearing, the debt-to-equity ratio. The capital structure must remain stable.
Okay, constant gearing, condition 2.
Condition 2. The new investment project must carry the exact same level of business risk as the company's existing activities. The project's operating risk must mirror the average risk of the company as a whole.
That second condition sounds really restrictive. How often does a completely new venture actually carry the exact same risk profile as the company average?
You've hit the nail on the head. It's very restrictive. In reality, new projects, especially diversification or expansion into new markets, often have different risk profiles.
So this limitation makes the standard WACC almost useless for many real-world investment decisions in dynamic companies.
It certainly limits its applicability. WACC is generally considered appropriate primarily for routine replacement projects, replacing an old machine with a new identical one, or perhaps for very marginal expansions within the company's existing core business, where the risk profile genuinely doesn't change.
So if either the gearing or the business risk of the project is different from the company average,
then the company's overall WACC changes, and using the old WACC to evaluate the new project would be incorrect. It would lead to poor investment decisions. In those cases, you absolutely must derive a project-specific discount rate that reflects the unique risk of that particular project.
which leads us into the next topics. Let's first delve into the effective gearing, Chapter 19. What exactly is financial gearing?
Financial gearing refers to the use of debt finance in a company's capital structure. Debt carries a fixed interest payment obligation. This fixed financial cost magnifies the fluctuations in returns available to shareholders.
How does it magnify them?
Think about profits before interest and tax, PBIT. If PBIT falls, the fixed interest still has to be paid in full before any profit is left for shareholders. So a small percentage fall in PBIT can lead to a much larger percentage fall in earnings per share, EPS, for a highly geared company compared to an ungeared, all-equity company. The fixed interest acts like a lever, amplifying the volatility of shareholder returns. This increased volatility is financial risk.
So higher gearing means higher financial risk for shareholders.
Yes. And consequently, rational shareholders will demand a higher rate of return, a higher tier, to compensate them for taking on this extra financial risk.
The material also mentions operating gearing.
Yes, that's related. Operating gearing refers to the level of fixed operating costs, like rent, salaries, in a company's cost structure compared to its variable costs. High fixed operating costs have a similar magnifying effect on operating profit fluctuations as fixed interest has on shareholder returns. High operating gearing increases business risk.
Okay. Now, how does gearing affect the overall cost of capital, the WACC? This brings in the Modigliani and Miller theories.
Correct. tackled this exact question in their famous propositions. First, in their initial model, Ignoring Taxes, 1958, they argued that a company's WACC remains constant regardless of its gearing level.
Constant WACC. How can that be if debt is cheaper than equity?
Their logic was that as you introduce cheaper debt, the benefit of that cheap debt is precisely offset by the fact that the remaining equity becomes riskier due to the financial risk we just discussed. This increased risk causes the cost of equity to rise just enough to keep the overall WACC unchanged. In this theoretical world without taxes, capital structure is irrelevant to the total value of the firm.
But we know taxes exist. What happened when included corporation tax?
When added corporation tax to their model in 1963, their conclusion changed dramatically. Because debt interest is tax deductible, creating that valuable tax shield, the after-tax cost of debt is significantly lower. Now, as gearing increases, the tax shield benefit grows, and the overall WACC falls.
WACC falls as gearing increases. What does that imply?
It implies that, theoretically, a company should aim for maximum gearing almost 100% debt to minimize its WACC and maximize its value.
That doesn't sound right in practice.
It isn't entirely realistic. The with tax theory is counterbalanced in the real world by factors they initially ignored, primarily the increasing costs of financial distress, bankruptcy risk, agency costs, that kick in at very high gearing levels. There's likely an optimal gearing level where WACC is minimized before distress costs become overwhelming.
Is there an alternative theory to
Yes, the main alternative behavioral theory is the pecking order theory. This suggests that managers don't actively target an optimal gearing ratio based on WACC. Instead, they have a preferred hierarchy or pecking order for raising finance.
What's the order?
They strongly prefer internal funds first retained earnings because it's easiest and avoids market scrutiny. If external funds are needed, they prefer straight debt next, as it's seen as less risky by the market than equity. Then perhaps convertibles or preference shares. Issuing new equity shares is seen as the absolute last resort, often interpreted by the market as a negative signal that the shares might be overvalued.
Interesting contrast. Okay, so that covers the gearing effect. What about the second factor that affects the required return business risk? This is where the capital asset pricing model, CAPM, comes in, Chapter 20.
Exactly. WACC is only right if the business risk is constant. If it's different, we need CAPM. CAPM provides a framework for determining the required rate of return for an investment based specifically on its systematic risk.
Systematic risk. What are the types of risk again?
CAPM starts by dividing total investment risk into two types. First, unsystematic risk. This is risk specific to an individual company or project, things like strikes, management mistakes, R&D failures. The crucial thing about unsystematic risk is that it can be diversified away by investors holding a well-balanced portfolio of shares.
So investors don't get rewarded for bearing it.
Correct. Because they can eliminate it for free through diversification, the market does not offer a higher return for bearing purely unsystematic risk.
And the second type?
The second type is systematic risk, also called market risk. This is risk that affects all companies in the market to some degree, things like changes in interest rates, economic recession, major political events. This risk cannot be diversified away no matter how many shares you hold.
And CAPM focuses only on this.
Yes. The core premise of CAPM is that the required rate of return on an investment should be based only on its systematic risk, because rational, diversified investors are only exposed to systematic risk.
How do we measure this systematic risk?
Systematic risk is measured by the investment's beta coefficient. Beta measures the sensitivity of the investment's returns to overall market movements.
What do different beta values mean?
A beta of 1 means the investment has average systematic risk. It tends to move in line with the overall market. A beta greater than 1 means it's more volatile, more sensitive to market movements, higher systematic risk. A beta less than 1 means it's less volatile, lower systematic risk. And a beta of 0 would represent a risk-free asset, completely uncorrelated with the market.
Okay, so beta measures the relevant risk. How does CAPM use it to find the required return?
It uses the famous CAPM formula, A rate T plus beta ERMRF.
Let's break that down. ERA is the expected return, or required return on investment. ROA is the risk-free rate of return, e.g. return on government bonds. Beta is the beta of investment ARA, and is the equity risk premium, or market risk premium, the extra return the market as a whole demands over the risk-free rate for bearing average market risk.
So required return, risk-free rate plus beta market risk premium. Precisely. It says the required return is the base risk-free return plus a premium that depends directly on the investment's specific level of systematic risk measured by its beta.
And we can use this for project appraisal.
Absolutely. If a project has a different level of systematic risk, a different beta from the company average, you should use CAPM to calculate its specific required return. That return then becomes the correct discount rate to use when calculating the project's NPV. It ensures you're evaluating the project against a hurdle rate appropriate for its own risk level.
This seems like the solution to the WACC limitation problem. But how do we find the beta for a new project?
That's the challenge addressed in Chapter 21, which cleverly brings CAPM and MM concepts together. We usually estimate a project's beta by looking at the betas of existing companies that operate in the same line of business as the proposed project.
But wait, those companies might have different levels of gearing than our company, or the project financing. Doesn't gearing affect beta?
It absolutely does. The beta values you find published for companies, for example, on financial websites, are equity betas. These equity betas reflect both the company's underlying business risk and its level of financial risk arising from its gearing.
So we need to strip out the gearing effect.
Exactly. We need to find the beta that represents only the inherent business risk of that type of activity, independent of how it's financed. This is called the asset beta, sometimes called the ungeared beta.
How do we calculate the asset beta?
We use a specific formula provided in the exam sheets that ungears the equity beta. It uses the equity beta of the comparable company and its market value debt-to-equity ratio and the tax rate to strip out the effect of its financial gearing, leaving us with the asset beta, which purely reflects the business risk of that industry sector.
Okay, so we find the comparable company, get its equity beta, and ungear it to find the asset beta for that type of business. What next?
This gives us the three-step, really apex procedure for estimating a project-specific discount rate. It's a very common high-level Section C requirement. Step 1. Find a suitable comparable company, a proxy company, operating in the same business area as the project. Obtain its equity beta and its market value gearing ratio. Then use the ungearing formula to calculate its asset beta. This beta now represents the pure business risk of the project's activity.
Okay, asset beta found. Step 2.
Step 2. Now, you need to reintroduce the effect of the financial structure relevant to the project. Usually this means taking the asset beta you just calculated and re-gearing it using the target gearing ratio of your company, or the specific financing mix intended for the project. This involves using the gearing formula in reverse to calculate the appropriate equity beta for the project, reflecting both its business risk and the financing risk it will have within your company's structure. Note, sometimes the syllabus simplifies this, especially if the project is treated as standalone, and you might just use the asset beta directly in CAPM if specific gearing isn't mentioned for re-gearing.
Okay, so ungear the proxy, then re-gear for our situation to get the project's equity beta. Step 3.
Step 3. Take the final correctly geared project equity beta and plug it into the CAPM formula we discussed earlier. RF plus beta, RMRF. This will give you the project-specific cost of equity.
And that, too, is the discount rate.
Yes. That resulting dollars is the theoretically correct discount rate to use for appraising that specific project via NPV. It reflects the project's unique systematic business risk and the relevant financial risk. Mastering this three-step ungearing CAPM procedure is really the pinnacle of applying risk theory to practical investment decisions in this syllabus. Okay, final section. We need to close the loop by addressing those financial risks we first identified way back in the FM's objectives specifically, the risks arising from fluctuating foreign currency exchange rates and interest rates. Chapter 22 starts with trying to forecast foreign currency exchange rate.
Can we actually forecast them accurately?
Right.
Seems notoriously difficult.
Extremely difficult in the short term, as they bounce around based on news, speculation, and capital flows. But economic theory gives us a couple of models that attempt to predict long-term exchange rate movements based on fundamental economic factors.
Like what factors?
Primarily, relative inflation rates and relative interest rates between countries. Exchange rates are ultimately determined by supply and demand for currencies, which are influenced by trade balances, investment flows, economic prospects, and these key price differentials.
Okay, so what are the models?
The first key theory is purchasing power parity, PPP. This is based on the law of one price. The idea that in the absence of trade barriers and transport costs, identical goods should eventually sell for the same price when expressed in a common currency.
So if a basket of goods costs more in country A than country B after converting currencies.
Then PPP predicts the exchange rate will adjust over time to equalize those prices. Specifically, it predicts that the change in the exchange rate between two currencies will be driven by the difference in their relative inflation rates.
How does the formula work?
The formula is usually expressed as $7 ceases us times 1 plus HD, 1 plus HB, where $7 is the expected future spot rate, $7 is the current spot rate, SG$ is the inflation rate in the country whose currency is being courted, the counter currency, and HB bull is the inflation rate in the base currency country. Essentially, the currency of the country with higher inflation is expected to depreciate.
Okay, that's PPP based on inflation. What's the other main theory?
The second is interest rate parity, IRP. This theory focuses on capital flows and predicts the relationship between the spot exchange rate and the forward exchange rate based on relative interest rates.
How does that work?
IRP posits that the difference between the forward exchange rate and the spot exchange rate, expressed as a percentage premium or discount, should be equal, approximately, to the difference in the nominal interest rates available in the two currencies for the same time period.
Why should they be equal?
Because if they weren't, a risk-free arbitrage profit would be possible. Investors could borrow in the low-interest currency, convert to the high-interest currency at the spot rate, invest it there, and simultaneously lock in a forward rate to convert back, guaranteeing a profit. IRP assumes arbitrage forces the forward rate to a level where this risk-free profit is eliminated. The formula is analogous to PPP, just substituting interest rates for inflation rates, near its HBT2.
Okay, so PPP and IRP give us theoretical forecasts. Now, Chapter 23 moves into actually managing foreign exchange risk. What types of risk are we talking about?
There are three main types mentioned. Firstly, transaction risk. This is the most immediate and commonly hedged risk. The risk that the exchange rate will move against you between the time you agree a transaction, like an import or export, and the time you actually pay or receive the foreign currency.
That's the main focus for calculations.
Yes, transaction risk hedging is the main focus for calculations in this syllabus. Secondly, there's translation risk. This is more of an accounting issue. The risk that the value of a foreign subsidiary's assets and liabilities might change when you translate them back into your home currency for group accounts consolidation. It affects reported profits, but isn't necessarily a direct cash flow risk.
And thirdly?
Economic risk. This is a longer-term strategic risk. The risk that unexpected exchange rate changes will affect the present value of a company's entire future stream of cash flows, perhaps by altering its competitive position in international markets, much harder to quantify and hedge.
Okay, focusing on transaction risk then.
Yeah.
We need to understand exchange rate quotations first. The bid-offer spread.
Absolutely crucial arithmetic. Banks quote two prices. A lower bid price, the rate at which they will buy the foreign currency from you, and a higher offer price, the rate at which they will sell the foreign currency to you. You always get the rate that is worse for you from the bank's perspective.
So if I'm converting foreign currency receipts back home?
The bank is buying the foreign currency, so you use the lower bid rate.
And if I need to buy foreign currency to make a payment?
The bank is selling you the foreign currency, so you use the higher offer rate. Getting this right is fundamental to all the hedging calculations. You also need to be comfortable with how quotes are expressed, often indirectly. For example, how many USD per GBP.
Right. Now for the hedging methods. Which ones require calculation?
Two main methods require detailed calculation in the exam. The first and simplest is using a forward contract.
How does that work?
You simply contact your bank today and agree on a fixed exchange rate, the forward rate, for a specific amount of currency to be exchanged on a specific future date that matches your transaction settlement date.
So it locks in the rate completely?
Yes. It completely eliminates the uncertainty. You know exactly how much home currency you will pay or receive. The downside is you also give up any chance of benefiting if the spot rate moves favorably by the settlement date. You must be comfortable calculating the forward rate if it's quoted as points or pips, premium or discount, relative to the spot rate.
Okay, forward contracts. What's the second calculation method?
The second is the money market hedge. This is more complex conceptually, but achieves the same goal of eliminating risk by effectively converting the currency now at the spot rate, using borrowing and depositing actions.
You explained this earlier for a receipt. Let's recap the logic. If I'm expecting a foreign currency receipt in 3 months.
Right. To hedge this using the money market. Step 1. Calculate how much foreign currency you need to borrow today, such that, with foreign interest added over 3 months, it exactly equals the amount of your expected receipt. Step 2. Borrow that amount from a foreign bank today. Step 3. Immediately convert that borrowed foreign currency into your home currency at today's spot rate. Step 4. Deposit that home currency in a home bank account for 3 months to earn interest.
And the result.
You have locked in a known amount of home currency today, plus the interest it earns. When the actual foreign currency receipt arrives in 3 months, you simply use it immediately to repay the foreign currency loan you took out. The exchange risk has been completely bypassed.
And the steps are reversed for hedging a future foreign currency payment.
Exactly reversed. For a payment, borrow home currency today, convert to foreign currency at spot today, deposit the foreign currency today so it grows with interest to meet the payment amount in 3 months. Use the deposit to make the payment, repay the home currency loan. Again, risk eliminated by acting today. Comparing the effective rate achieved via a money market hedge versus the forward rate offered is a very common exam requirement.
Okay, those are the calculation-heavy ones. What other hedging methods are mentioned just in theory?
You need to be aware of currency futures. These are like forward contracts, but they are standardized. Fixed contract sizes, fixed maturity dates, and traded on formal exchanges, not directly with a bank. Requires dealing in whole contracts.
And currency options.
Options give the holder the right, but not the obligation, to buy or sell currency at a fixed exchange rate, the strike price, on or before a future date. You have to pay a non-refundable premium upfront for this flexibility.
Why pay a premium?
Because it gives you the best of both worlds. If the spot rate moves against you, you exercise the option to get the protected rate. If the spot rate moves in your favor, you let the option expire worthless and trade at the better spot rate. It's insurance against downside risk while retaining upside potential.
Any others?
Lastly, currency swaps. These are usually longer-term arrangements between two companies. They might agree to exchange a principal amount in different currencies now, make each other's future interest payments over several years, and then re-exchange the principal at the end. Often used to access cheaper borrowing in a foreign market or manage long-term currency exposure.
Got it. Okay, final topic. Interest rate risk management. Chapter 24. What's the core risk here?
The primary risk we're concerned with is the risk that interest rates might change adversely between now, when you perhaps agree to take out a loan or plan to make a deposit, and the future date when the loan actually starts or the deposit period begins. You're exposed during that gap.
So how can companies manage this interest rate risk?
Several methods exist, similar in concept to currency hedging. You can use forward rate agreements, FRAs. These are over-the-counter OTC contracts with a bank that fix an interest rate today for a specific loan or deposit amount for a specific period starting at a future date. It locks in the rate, like a forward currency contract.
What about options for interest rates?
Yes, you can use interest rate guarantees, IRGs, also called interest rate options. These are OTC options. A borrower might buy an IRG, often called a cap, which sets a maximum interest rate they will have to pay. If market rates go above the cap rate, the bank compensates them. They pay a premium for this protection, but can benefit if rates fall below the cap. Depositors can buy floors to set a minimum interest rate.
Are there exchange-traded interest rate products?
Yes, interest rate futures. These are standardized contracts traded on exchanges based on underlying interest rates, like LIBOR or government bond yields. Companies can use them to hedge. For example, a borrower worried about rates rising would sell interest rate futures today.
Why sell? That seems odd for a borrower.
Because interest rates and futures prices generally move inversely. If interest rates rise, bad for the borrower, the price of the interest rate future will fall. By selling futures now and buying them back cheaper later when rates have risen, the borrower makes a profit on the futures trade. This profit helps offset the higher interest costs they now have to pay on their actual loan. The net effect is to lock in an effective interest rate.
Clever. Inverse relationship is key. Any other terms? Caps? Floors?
Yes, those options caps, bought by borrowers to limit upside rate risk, and floors, bought by depositors to limit downside rate risk, can be combined. A company might buy a cap and sell a floor simultaneously, creating a collar. This limits their interest rate exposure within a defined range, and selling the floor helps finance the premium paid for buying the cap.
And finally, interest rate swaps.
Similar to currency swaps, two companies agree to exchange interest payment obligations. Typically, one company swaps its floating rate payments for the other's fixed rate payments. This is often driven by exploiting differences in their relative credit ratings in the fixed versus floating rate markets. Each borrows where it has a comparative advantage, and then they swap to achieve the desired interest rate structure, fixed or floating, more cheaply than they could directly.
Hashtag TED Tag outro.
Wow. That was an immense journey. We really did traverse the entire mastery framework today, didn't we? From calculating the economic order quantity in that daily survival game of WCM.
Right up to the complex nuances of estimating an asset beta using proxy companies.
And navigating those really quite counterintuitive steps for setting up a money market hedge. It's a huge amount of ground covered.
It is. But this framework, this structure we've outlined, this is genuinely your key to mastering this subject for the exam. Remember, the notes, the formulas, they're just the tools in your toolkit.
The real skill is understanding the context, seeing the crucial trade-offs everywhere, like profitability versus liquidity in WCM, or risk versus return in investment. And most importantly, focusing on the deep application of these concepts. That's the exam-winning skill. Always challenge yourself, not just to calculate the result, but to explain why that result actually matters to the financial manager making the decision.
That's great advice, context and application. So we should probably leave our listeners with one final thought to mull over, shouldn't we? Maybe linking back to the start.
Good idea. Let's return to that foundational concept of the efficient market hypothesis from Chapter 2. We established, based on the evidence, that the market is likely, at best, semi-strong form efficient.
I mean, prices reflect all public information very quickly, but not necessarily private or inside information.
Exactly. Now, what does that really mean for you? It confirms that financial expertise, rigorous analysis, applying the skills you've just been learning, it still holds intrinsic, tangible value. If the market was strong form efficient, analysis would be pointless.
So the implication is opportunity.
Precisely. It raises a provocative question for you, the newly informed, aspiring financial manager. Given that the market only reflects public information efficiently, how much genuine, maybe even abnormal advantage can you potentially gain by analyzing that publicly available information faster, more deeply, and perhaps just better than the rest of the market?
Food for thought indeed. How much edge can superior analysis provide? Think about that as you continue your own deep dive into these materials.
Absolutely. Good luck with your studies. It's a challenging paper, but definitely passable with the right structured approach.
Indeed. We'll see you next time on The Deep Dive.